It all began with a single remark. And that one sentence nearly sent the US dollar into freefall. Treasury Secretary Scott Bessant stood before reporters, promising a strong American reaction to China's sudden export restrictions. The statement hit the wires, and within hours, Beijing's markets surged, Wall Street shuddered, and rare earth futures spiked over 12% overnight. Then came the quiet retreat. By nightfall, the White House scrubbed his words from the official transcript, replacing them with a softer phrase. "We'll review all options." One edit. Billions in losses. The question hung in the air. What did Bessant learn that made him backtrack so fast? New data from Bloomberg later revealed that China's rare earth shipments to the US had plunged nearly 37% in April before bouncing back slightly in July. The brief disruption was enough to show how dependent America still is on foreign sources. Since refining operations shifted to Inner Mongolia back in the 1990s, China has tightened its hold over more than 80% of the world's rare earth processing capacity. The US tried to rebuild capacity by reopening the Mountain Pass mine in California. Yet Reuters noted that over 90% of what's extracted there still ends up being processed in China. Even America's domestic production flows back through Chinese factories. Bessant wasn't blind to this. During his Senate hearings, he had already warned that America's own economy could be turned against itself if it failed to strengthen its industrial backbone. Yet the Treasury's approach still leans on low-cost imports to keep inflation in check. When testifying before Congress, Bessant accused Beijing of economic manipulation, referring to export monitoring rules Beijing had introduced on July 1st. China said the measures were about national security, the exact reasoning Washington used when it limited chip exports the previous year. The irony was impossible to miss. When a Financial Times reporter asked him about the resemblance, Bessant dodged, saying only that the US operated under global trade norms. But markets weren't paying attention to speeches. They were watching reactions. Over the next 3 days, the 10-year Treasury yield jumped 26 basis points. Investors weren't dumping bonds yet, but they were preparing for the possibility that China might. By August, Treasury records confirmed that Beijing had cut its US debt holdings again, this time by $25.4 billion, leaving its total at $744 billion, the lowest level since 2009. It wasn't a sell-off, it was a signal. Meanwhile, China's own economy was powering ahead. Customs data from Reuters showed exports climbing 8.3% year-over-year in September, the fastest pace in half a year, totaling around $330 billion. But the real shift wasn't in volume. It was in direction. Shipments to the US plunged by 27%, while exports to ASEAN nations, Africa, and Latin America surged by double digits. Analysts at Nomura called it a deliberate redirection of trade routes away from tariff exposure. China wasn't slowing down. It was rerouting around Washington. At his next press briefing, Bessant tried to walk a tightrope. He condemned China's restrictions as provocative, but insisted that America still sought a path of open dialogue. The mixed message was obvious. Confrontation and diplomacy in the same breath. The Wall Street Journal described it as a live reversal of tone. Behind the stage, Washington's choices were shrinking. If the US moved forward with Trump's proposed 100% tariffs on Chinese imports, it risked provoking a full-scale embargo on rare earth materials, a move that could cripple America's defense manufacturing within months. But retreating publicly would appear weak. The Treasury's solution was to blur the lines and stay vague. IMF data from the third quarter of 2025 revealed the underlying truth. America's goods deficit widened by $11 billion, while China's surplus hit a 10-month peak. The imbalance wasn't about consumer goods anymore. It was about the resources driving the green energy transition. China now supplies roughly 70% of the world's lithium-ion cells, 80% of solar wafers, and 60% of processed graphite, all critical for electric vehicles and renewable energy. Every one of those materials feeds into America's reindustrialization programs. Cutting them off would mean halting progress on its own energy agenda. Bessant's problem in the end wasn't political, it was mathematical. Every time Washington raised tariffs, domestic prices climbed higher, forcing the Federal Reserve to keep interest rates elevated. That, in turn, made the dollar stronger, crushing U.S. export competitiveness and deepening its dependence on foreign goods. China, meanwhile, could absorb losses through state-owned banks and still maintain export growth. The imbalance was baked into the system. Nowhere is that clearer than in the semiconductor race. The CHIPS Act had pledged $39 billion to rebuild America's chip industry. But by 2025, less than a third of that money had actually been distributed. In the gap, Chinese firms quietly expanded abroad, offering low-cost fabrication partnerships in Malaysia, Thailand, and Mexico. Instead of isolating China, the policy globalized its reach. Even Japan's trade ministry admitted, We are diversifying through China, not away from it. Even the dollar's dominance, once untouchable, is beginning to slip. According to SWIFT data in August, the yuan's share of international transactions climbed to 5.8%, its highest level ever, while the dollar's share slid below 47%, a low not seen since 2012. The numbers still favor Washington, but the trajectory speaks volumes. Every percentage point the yuan gains weakens the dollar's global leverage. Bessant's talk of financial containment might sound strong in DC, but in Asia's financial centers, it's starting to sound nostalgic. And through all this, Beijing hasn't fired a single economic shot. It hasn't cut off rare earth exports or enforced new quotas, because it doesn't need to. The fear alone is enough. The World Bank's September outlook showed rare earth prices up 18% since April, even though actual supply hasn't changed. Economists call it anticipatory inflation, markets pricing in panic before it even happens. In this quiet standoff, China's silence is the most powerful move of all. Market reactions have begun inflating prices based solely on speculation, and every minor surge chips away at the edge U.S. manufacturers still have, something no tariff can make up for. So what's Bessent's real objective? Publicly, he calls it a matter of safeguarding supply chains. Privately, it's about political cover. Reports from Reuters reveal that Trump has been impatient, unhappy with the lack of concrete achievements from the tariff strategy, and he's demanded a major breakthrough before year's end. Bessent's resistance toward Beijing was designed to project firmness without crossing into direct confrontation, a delicate act no Treasury chief has managed since the James Baker era. Yet the world economy doesn't bend to press statements anymore. It moves with production. And in production, China holds the advantage. Industrial output there climbed 6.2% in September, while America's manufacturing barely scraped 1.8%. China's PMI has returned to growth territory above 50, while the U.S. index remains in contraction for the 15th consecutive month. The truth behind those figures is simple. Tariffs can redirect trade, but they can't reshape where efficiency truly lies. Inside Treasury, the divide has deepened. One faction is urging a harder stance, expanding export restrictions to Chinese logistics and data systems, while the other calls for diplomacy, worried that escalation could infect global finance. As one senior official told the Financial Times off record, "You can't cut off China without cutting into yourself." That statement might not make it into public documents, but the markets have already absorbed its meaning. Credit default swaps for top U.S. companies jumped 9% in late September, the sharpest spike since the banking turmoil of 2023. Anxiety, once theoretical, has now turned measurable. Meanwhile, China's inbound investment is climbing, not shrinking. Data shows foreign direct investment rising 6.4% year-over-year in August, largely from German and Southeast Asian manufacturers repositioning for southern markets. The Wall Street Journal observed that Beijing's export model is evolving, from volume-based trade to influence-driven strategy. That influence now extends to energy deals priced in yuan, infrastructure lending across Africa, and commodity trade settling in Shanghai rather than London. What was meant to isolate China is, paradoxically, weaving it deeper into the global system. Still, Bessent's tone stays defiant. On CNBC last week, he declared, "We won't step back from protecting American industry." Yet protection doesn't equal victory. The logic of escalation collapses when your competitor anchors the cost base of your own economy. That's why, behind closed doors, the planned 100% tariff rollout has quietly been paused, officially labeled under review, but functionally abandoned. Bloomberg analysts described it as caution disguised as paralysis. Wall Street's immediate reaction was relief. The S&P 500 jumped 3% in a single day after the announcement. But that rally was built on irony. Investors weren't celebrating success, just the avoidance of crisis. Even Goldman Sachs' Jan Hatzius admitted, the U.S.-China trade setup now operates under mutual restraint. In plain language, both sides are too interconnected to sever ties, yet too wary to rebuild trust. If there's a subtle winner here, it's Beijing. Just as Bessent's rhetoric peaked, China released data showing retail sales climbing 4.9%, and record auto exports, particularly electric vehicles, to Latin America and Eastern Europe. Those regions are now absorbing production that once headed for U.S. ports. Tesla's Shanghai plant alone exported 64% of its vehicles last quarter, up sharply from 47% the previous year. This shift isn't rebellion, it's diversification. And diversification shields against vulnerability. In Washington, these moves are read as provocation. In Beijing, they're seen as adaptation. Both perspectives hold some truth, but only one aligns with measurable progress. IMF forecasts for 2026 place China's share of global manufacturing at 32%, its highest ever, while America's drops below 15% for the first time in history. This widening gap isn't just the product of flawed policy, It's embedded in globalization's structure. You can't correct a cost imbalance through tariffs without overhauling how your own economy produces. That's the part Bessent avoids saying aloud, because acknowledging it would mean admitting the US has fewer levers left to pull. With $38 trillion in national debt, fiscal policy is cornered. The Federal Reserve is caught between inflation control and political pressure. Industrial policy remains reactionary rather than visionary, and every domestic manufacturing plan, from semiconductors to defense supplies, still runs through Chinese supply routes. The irony is bitter. The so-called rare earth minerals China dominates aren't truly scarce. They're just environmentally costly and unprofitable at small scale. Beijing accepted that burden decades ago. Washington outsourced it. Now the same environmental ethics once seen as virtue have become strategic vulnerabilities. The markets aren't punishing China's dominance. They're rewarding its appetite for industrial risk. By early October, Treasury briefings had already softened. The language shifted from decisive action to cooperative frameworks. Behind those polite phrases lies a quiet acknowledgement. Economic confrontation has boundaries when both powers depend on the same global machinery. The US can threaten tariffs. China can reroute trade. Each move cancels the other's leverage. What's left is performance, and performance alone can't sustain confidence forever. The real question isn't whether Bessent folded. It's whether he ever had a viable move to begin with. When your rival controls the resources, the processing, and increasingly the financial medium of exchange, conflict becomes a matter of pacing, not outcome. Beijing seems at ease with that pace. Washington does not. As China expands exports, deepens partnerships, and quietly trims its U.S. Treasury holdings, the narrative shifts from confrontation to inevitability. The trade war meant to restrain China has ended up proving how far the balance of power has already tilted. Thank you for watching. Don't forget to like, subscribe, and check out our next deep dive on the shifting dynamics of global power.